Good morning, everybody. Welcome to Coffee with KPP Live, the show that is dedicated to providing you with advice for life so that you can live richly and work towards the life that you've earned. My name is Ben Hopper, Certified Financial Planner with KPP in Louisville, Kentucky, and I am joined today by our CEO and CFP, Rob Davenport. And Rob, today I think we really want to address an elephant in the room. We kind of called it before our show, which is the economy and the stock market. What's going on? What are we seeing? It's been a crazy year. And yesterday we actually had a meeting that was very challenging. One of the most challenging meetings we've had with one of our clients, showing that the client was actually down in market value over 7 figures year to date. That's a very hard conversation to have, but I would suggest that by the end of the meeting, things were pretty positive. Everyone was calm, cool, and collected. So what we want to talk about today is some of those things that we discussed and why was everybody okay by the end of that meeting yesterday.
Well, good morning. I know this is a topic that's on everyone's mind, the stock market, the economy, the challenges we're all facing, all that we hear on the news, regardless of the channel you watch. Typically it's filled with negativity and the sky is falling. But yesterday's meeting was challenging, but it ended up okay. And it ended up okay because our client has a financial plan. And we were able to go back through the financial plan, recalibrate the numbers, so to speak, adjust them for their lower values currently, and run the mathematics. And the mathematics show that that family is in good shape, even with an unrealized loss, a paper loss of a very large sum of money. So this is what's happening today. Investors are starting to test their emotions and their capability for withstanding extreme volatility. And I think that's what we want to talk about today is why is this happening? How should we behave? What should we be doing? And though this call is not an hour in length, but maybe 15 minutes, I think we can touch on some of the high points regarding these concerns. So there's, I think we have to put things into perspective. You have to understand that the stock market and investing in the stock market is a lifelong experience. You can't be in the stock market for just a little while and expect to have a positive experience all the time. You have to be invested in the market really over your entire lifetime. And so I think that's something that we have to first understand is how long is our runway to own these stock-based mutual funds or these balanced mutual funds or whatever you have in your portfolio. And I would argue it's your entire life. You should die having owned and still owning some of these stocks or stock-based funds and ETF types of products. So it's not like we're going to invest up until retirement, and then once retirement occurs, we go to cash. That's not what we do in this business, and that's not right for the client. So please understand that if you're going to be in the market, you're going to be in the market for decades. And that's actually very helpful because the longer you're in the market, the better we're going to come out on the other side. Because typically the market rewards those who have patience and who have a long time in the market.
And when we say market, I know we've talked about it on the show quite a bit, but we actually were looking at the common things that we think of when we think of market, which are the S&P 500.
Yeah, so where is the S&P 500? Year to date, Ben, give us the major indices. How bad is it year to date right now?
Yeah. Good to put things into perspective that way. 24% is the S&P 500. That is what the S&P 500 is down. The largest 500 U.S. companies year to date, 24%. That's the most common index we look at when it comes to the market. but there's others too.
Right.
The Russell 2000 would be small and medium-sized companies, small and mid-cap, represented in the Russell 2000. Tends to be a little bit more volatile and a little bit more challenged in times like this. 27% on the Russell 2000. The NASDAQ, which is the 100 largest technology-based U.S. companies, down 32%.
Wow.
Technology companies tend to be more growthy when interest rates rise. Growth-oriented companies have a hard time borrowing money to grow because it costs more to borrow that money and grow, so they are down more. 32%.
So why don't we just be in bonds then?
Yeah. Bonds. So the bond index, the aggregate or AG, is down 15.5%. So that has been by far the worst year, first 9 months of a bond market ever. And so the conversations that we're having is that there's really been very few places to hide, I think.
Other than cash.
Other than cash.
But cash, as you know, you earn very little to nothing. And there's a purchasing power risk, right? Inflation is soaring right now, and dollars in cash, while they may not be going down via market value, you are falling behind slowly due to inflation. But those are really scary returns year to date. I mean, we just heard minus 15 on the aggregate bond index and a range between minus 24 and minus 32 on the equity indexes. So I get it. I understand why we're all freaking out. I understand why people are nervous. I suppose what I'm here to say is this too shall pass. It may take a while. I don't know if this will pass in a year. I don't know if this will take a decade. But I want to remind people that you need to take time out of your schedule, meet with your financial advisory team, and determine what is your comfort in risk and how much risk you should take inside of your various accounts that you have established for your future. I will say that if you have a long runway, in other words, you have many years until you're about to retire, the one type of product that I would suggest that you think about maybe turning up the risk, becoming more aggressive in, is inside of a 401k. Now, why is that? A 401k receives a deposit every time you're paid. So it's going to receive 24 or 26 deposits a year. And this is called dollar cost averaging. So if you have a market that has gone down, this is a great time to be buying in at those lower share prices during the time in which the market has come back down. So you'll be buying in more, and accumulating more shares per each dollar that you're investing because the shares cost less. So I would highly recommend that you think about how much time you have until you retire, and think about how can you take advantage of dollar cost averaging theory and apply that to your 401k. So I'm of the belief that it's okay to be a little bit more risky inside your 401k allocation than maybe you might have outside. So we're a big proponent of people having cash in the bank, enough emergency fund dollars. But then we really have to measure how much risk a person's willing to take with inside their non-IRA accounts or accounts that are managed by their financial advisory teams. You can only do that by going through a risk tolerance assessment of some kind. We have really neat tools on hand, of course, but you can only do that if you spend the time to really think about how much tolerance you have for temporary loss. Okay, so let's go back to what's going on with the markets, because that's important. Ben, let's talk about all the concerns. And pardon me while I look at some notes here, but I'm going to just talk about some of the concerns that we all are seeing today and hearing today. And then maybe, Ben, you can tell me where we have some sunshine, where we have some positives. So let's just kind of put this into perspective.
And there is some sunshine.
Yeah, there is. There is. So the Fed is raising rates. You hear the term, they are being hawkish, meaning they are aggressively raising rates. Now, why are they doing this? Well, they're doing this to to slow down inflation, to try to suffocate the economy, so to speak, so that borrowing becomes a little less. It becomes a little bit more expensive to borrow dollars to apply to your business, and it's more expensive for someone to get a mortgage and afford a home. So growth in the economy is going to slow as a result of the Fed becoming hawkish. Hey, they might raise rates too quickly. Time will tell, but we all see it, and this is a pretty aggressive Fed chair we have now. Inflation is high. We understand that. Inflation is very high. It's concerning to all parties, so that's a major concern. And it's gone up awful quickly, has it not?
It has.
And we'll see. It is starting to come back a little bit, so that's a good sign. Of course, we all know the Russian-Ukraine conflict. That's a tragedy. We hope that subsides over time. Sounds like the Ukrainians are gaining a little ground in that area, but we'll see how that plays out. It might make for a difficult winter in Europe with some of the oil and gas exports being reduced by Russia, possibly. And oil prices, as a result, here in this country have gone way up. And we don't want to get into politics, but the reality is we've got quite a few tsunamis hitting us at one time, right? Investor sentiment is very low. What's interesting, though, is when investor sentiment is low, that's really historically the time to be buying equities, right? When investor sentiment is very, very high, almost euphoric, that's the time when we should probably be trimming equities. Okay, interesting how that plays out. And of course, mortgage rates have gone up. They've doubled. So that's a concern, and that's due to rising interest rates. So we do have concerns right now, but there are some positives. There are some positive signals. And Ben, you want to tell us a little bit about those?
Sure. One of those, interestingly enough, is actually inflation. We've talked about inflation being a negative. And of course, that has been over the last year, the Federal Reserve stepping in to aggressively curb inflation. One of the positives on that note is that we are seeing signs that it may be peaking. We can't predict the future. We don't have a crystal ball. The Fed has indicated what it might do, which is continue to raise rates to curb inflation, but we have to see how that plays out. The hardest thing to do is to try to time that, and we don't want to try to time and predict that. But there are signs that inflation is peaking. What are some of those signs? Biggest one is actually the money supply. How much money is out there in people's bank accounts, savings accounts. That's really what dictates inflation. More dollars chasing the same number of goods.
Right.
Money supply has actually steeply dropped in the last year. During COVID, right after COVID, there was a lot of stimulus. The government had done a lot of money injection into the economy. There's some staggering statistics on that note. That has actually come considerably down as people have spent money, rates have risen, inflation has happened, which causes people to have to spend more on groceries, gas at the pump. As a result, the money supply has gone down. Could be a sign that inflation is peaking. Other job growth is a big one. Yeah. One of the question marks of, hey, are we getting into a recession, is that if we are coming into a real recession, it doesn't look like others. Right. Because of how many jobs are available out there, how many unfilled jobs we have, does not look like an historical recession. So that's a positive sentiment, is that there's a lot of unfilled jobs. Employers are still begging to hire people. That's not very recessionary in nature.
That's right.
The dollar, the U.S. dollar has continued to be strong. Of course, that affects other international economies quite a bit, imports and exports, but the dollar has remained strong throughout this year. And then the last one, well, to Rob's point, the investor sentiment. When times are tough and people are challenged, that tends to be the time that the markets could correct and do better. We want to try to buy on these dips, buy low and sell high. The stock market valuations, because of those staggering numbers we've seen, have been reduced.
That's right.
So things like price to earnings ratios and valuations, we are seeing more attractive entry points in both the stock and bond markets because it's not as expensive as it was a year ago to buy equities. Some companies, some stocks, some areas might be more fairly priced than they were a year ago because of the drawdown. We were talking a lot last year about things being overpriced and overvalued. Because of the drawdown, a lot of those have started to be corrected, which could produce some entry points, sometimes to buy, some sectors that could see a rebound.
More fairly valued. I find that one statistic that's positive. We've had 20 consecutive months of positive job growth. So that, to your point, doesn't sound very recessionary to me. But look, folks, it's challenging. We've got a lot going on. Investors are nervous. They keep opening up statements and they see losses. And at some point, they're going to reach their breaking point. What I suggest is everyone take a deep breath. Calm down. Build a financial plan. Run the mathematics. In other words, figure out where you are today in numbers, in mathematics, how much money you have. Figure out what your retirement's going to look like. Have a financial advisor like our team and other teams associated with KPP or anyone that is qualified, okay, that has high ethics, morals, values, knows what they're doing, has a good team. We've got to help people with a plan. People have to stop, take a deep breath, build a financial plan, measure how much risk they have, measure how mathematically successful or less than successful their current trajectory is. You have to have a financial x-ray. If you are doing this without a financial x-ray, you're flying blind. And all of your focus is going to be on investment results, not on a strategy to accumulate the proper number that you need at some point down the road. That's what financial planning does. We get you organized, we run the projections, we run the math, and every 6 to 12 months, we sit down with you and we see how are we doing. Are we on course or are we off course? Now is a very, very wise time to build a plan, okay? And to really analyze how much risk you have into what we're trying to accomplish and how successful or how much challenge we have ahead of us. This will pass. I believe this will pass, but it may take a while. We don't have any crystal ball, but that's why you must remain patient if you're going to invest in the stock and bond market. You must have patience. Yes, Ben?
I was just going to say the one area that we didn't get to hit on a lot, which we don't have to go into a deep dive of this, is actually the history of the stock market. Rob and I were looking at the Dow Jones since the Great Depression, 1920, and the reality is that the one tagline that we picked up on yesterday that we like is that bull markets, which is good times in the economy, are measured in years. Bear markets, which is what we could be in right now, when times are bad, downturns are usually measured in months or quarters. What does that mean? It means that over a long period of time, the times when the market has done well, when the bulls have run, has greatly outweighed the times that are bad. And we have seen a bull market for the last 10 plus years coming out of the '08 recession. It really has been up and to the right ever since then. And we're seeing some reset right now.
That's right. So we have no way of predicting the future. All we can say is do the right thing, and that is pause. Don't overreact emotionally. Act more logically. Sit down and calmly build a financial plan with your spouse if you are married. Have both people on the same page. Work with your team to figure out, are you okay? Or what do we need to do to help get you okay, if possible. So the market is a volatile place to be, especially today. We've had a very bad start this year, but this does not mean it's the end of the world. This does not mean the market's going to go to zero and we're all going to lose all of our money. That's probably not going to happen. But the reality is should you have concern? Sure, we all have concern. Should you build a plan? I suggest you do, because that way you have an x-ray to know how much you need to accumulate and how are we going to do it with the time that we have left before you have your retirement party. And even during retirement, you're not going to be out of stocks. you're going to have diversified portfolios of all different kinds all throughout your retirement, generating income for you, maybe growing those assets if at all possible, things of this nature. So at KPP, we're here to help you. There are, I'm sure, wonderful firms out there that can help you, but the reality is you have to find someone that you trust, that you like, that you know has high ethics, morals, and values, which is very important in this line of work, and can sit down with you and measure and consult with you. Not sell things to you, but sit down and analyze and consult with you like a professional would. That's our message today. You're going to be okay. We're all going to be okay. It doesn't seem like it today and this year, but I do believe long term we're going to be okay.
Excellent. Great advice. Thank you all so much for tuning in. We greatly appreciate it. Follow us on the Facebook page if you don't already. If you're viewing this, you probably do.
Yeah.
But please give our office a call if you have any questions. Our number is 502-394-0400. We're located in the heart of Louisville's east side with several regional offices now as well that we're very excited about. Right. So give us a call. Let us know if you have any questions. And thank you for tuning in. Have a great day.
Thank you.